We always like to start, of course, with a summary of what we saw happening here in the stock market this week. Now, I normally have a shorter term chart. This one I have weekly data, so every point on here is a week, going back to really the kind of the beginning of 2007, because I just want to talk about some of the longer term trends. We're really getting a lot of news right now about things that are happening now, right, with the House of Representatives, the situation in Israel, et cetera. So let's make sure that we have some perspective, on the overall trends and what's going on here. And so you can see here the S&P 500, we bottomed out March 9th, 2009, and then we had a very nice run up until 2018. We had technically a bear market there with a 20% drop, and then recovered from that. And of course, then we had that big drop from the pandemic, which was a 35% drop. Probably should have ended up in some form of massive recession / depression from that, but they pushed out money, tons of money. $10 trillion is the number I keep hearing between the Treasury, the Federal Reserve, and Congress. And look at the effect of the stock market. It went basically straight up instead of going down, and recovered very quickly. But it created inflation. So the all-time high that we had there on the S&P 500 on the 4th of January of 2022 is really kind of artificial because of that money that came in. And of course that caused inflation, and we've had this rocky ride last year down to October 13th. And now we're on this trend, and I drove a little trend line in there. We're actually attacking that trend today, so we'll see what happens. One thing to keep in mind about today, always, the third Friday of every month is options expiration day. It seems to me that the market is down almost every time that happens, as these options are exercised and what have you. And it may not be relative to really the overall trends and what's happening. So be a little bit careful with what's going on that third Friday of every month. But nonetheless, we're still holding up that trend essentially. And we are above our support levels at 4,200 to 4,100, which is very critical. And so, we're still going up, and the uptrend is still in track. And if you look, we're kind of on track for where we might have been without that big bubble from the pandemic. And my theme has been for quite a while here that really we're just still unwinding the pandemic. I know it seems like it's sort of in the rearview mirror, but economically it really isn't. The inflation is still there that was really brought in by that money from the pandemic and the shortfall of supply, labor and goods and what have you. And let's look at the bond market also, because there's a lot of news about the bond market right now, having this horrific time and a bad year and whatnot. But you need to put that in perspective. So this is going back to about the same time frame, early 2007. This is also weekly data. We're looking at the Vanguard Total Bond Market Index, ETF, as a measure of the overall bond market here in the U.S. And so I draw a line right there where it is now. Okay, so yes, it's down, but we also have to remember how much it went up.
That run-in from the pandemic.
And so it's a bubble, just like the stock market bubble that we just looked at. Maybe a little bit behind the stock market in that sense, but where we are right now, we're at for quite a few years there, and things are okay at that level. We had decent stock markets, and so really this is a lot. Again, we're unwinding the pandemic, getting back to a 5.25% to 5.5% rate from the Fed funds rate. Even a 6% rate is pretty normal. Those are things where the market has done quite well. But when you go from 0 to 5.5 in a very short period of time, that adjustment's hard, right? And so, we saw in the banking system. So the banks had bonds, that they had purchased with the deposits that come in. All of a sudden, those bonds are worth less. They've got a shortfall in their capital requirement. They're going out to the market to try to find that, back earlier this year. And all of a sudden, those banks are starting to get, a run on the bank, so to speak. Government had to step in. And so, there are things that do happen when these scenarios happen with bonds, et cetera. Right now, the falling bond market's putting a lot of pressure on banking system, corporate bonds, those types of things. It's kind of leaking through to lots of areas. However, it's not that much higher than it normally is, It really isn't. And we're just getting back down to normal here. And it's a painful adjustment, okay, as far as that goes. But nonetheless, that's where we're at. If you look at the stock market again, that trend is still there. The upward trend is still okay. If we look at the bond market, we've still got a situation where we're kind of getting back to normal.
Yeah, we really got used to having a below average interest rates, and
Yeah.
people just got used to that as the norm.
Right.
And for our history, we've been around higher than that.
Yeah, exactly right. And we've functioned at those levels without any real problem. 95 to 2000 was one of the best 5 years in the history of the stock market. And my recollection, and I could be wrong here, was that the Fed funds rate was right around 6%, roughly around where it is now. And so, there's plenty of room for the market to move here. We're just readjusting back to kind of this, I guess it's almost like a sugar high that we had from all of this money that came in to
Cheap
save
money.
us from the pandemic. You can make arguments whether we should have done that or not done that, or we did too much or what have you, but if we didn't do anything, I think we'd still be talking about the Great Depression that we're in right now.
Yeah, hindsight's 2020.
Yeah.
You never know how much you need from this when you're in the heat of the moment.
I remember Jim Harbaugh, the 49ers coach at the time, and they'd gone for the touchdown in the Super Bowl, against, I think it was Baltimore, 3 times in a row, threw the ball to Crabtree every time. And they asked him if he would have done something different, and his comment was, coulda, woulda, shoulda is undefeated. I still like that because it's very true, especially when you're looking at, the stock market as far as that goes. So very interesting. Okay, then the other thing, of course, with this Israel conflict that's happening here, it has the potential for creating a higher oil price. And higher oil price is a real problem, especially right now. Because of the situation with inflation already being fairly high, and oil comes through everything we buy, every service. The restaurant uses energy, the goods that get you from Amazon is using energy. You go to Target, that stuff got delivered there somehow. So as that pricing comes up, it can really create some problems with earnings and or those price increases being passed along to the consumer as a problem for inflation. So what you have here is a long-term, again, about the same, early 2007 chart of West Texas Intermediate crude oil pricing. Right now, about $88. I drew a line all the way across there, kind of where it is now. We've been around this pricing quite a bit. I don't see this pricing where it's at right now as being an issue. And so far during this conflict, it has more or less stayed in this range. It's been kind of in that 88 to 93 range, as far as that goes per barrel. And however, that is the threat there, a contagion, Iran getting involved, whatever it might be that could interrupt the supply of oil in some form or fashion, right, that could create problems. So, however, again, at the moment, we're just kind of back to a sort of a normal area for oil. And you can see how low it got just over my shoulder here during the pandemic. And that's because nobody was using it.
Yeah, there's times when it went negative too.
Yeah, that's right. It cost more to store it than it was worth at that time. So kind of wild. All right, so here's another thing. Wage growth. So here's another risk factor. So inflation, I think, is the biggest risk. Okay? Recession is off in the distance at this point. And I've been saying that for quite a while. I still feel that that's true. Oil is an issue for inflation, right? And so is the wage growth and how much people are getting paid. And so right now, the wage growth is at 5.2% as of last month, year over year. Not quite enough to keep up with inflation. And so we're seeing some, strikes that are happening and what have you. And so we'll have to see what happens with wage growth as kind of employees push back on that. But the overall trend for wage growth is slowly but surely coming down, not up. And so, again, that's something we watch for, but the trend's going in the right direction. So we got the market overall going in the right direction, the bond market getting back to normal. Oil is kind of at an average price. We've got wage growth that's, somewhat reasonable in terms of its trending motion as far as that goes. The average wage growth is 3.74%. Okay, so 5.2 is higher, reflecting the higher inflation and the tighter job market, right? But not out of control. That's a healthy number. That's not a bad thing where we're at right now. And then kind of the last, not the last, second to last thing is just inflation itself. So please keep in mind that core PCE, remember that, core PCE, that's what the Federal Reserve is looking at. PCE is the price, personal consumption expenditure index, and that is essentially the basket of goods that the Federal Reserve looks at for inflation. And they look at the core portion, which excludes food and energy, which they feel they control more of the core aspects of it. That's at 3.88% right now.
Yep.
And so really need to get that to 2. Still got a ways to go.
Yeah, we'll find out a week from today.
Yeah, because it always comes out at the very end of the month for the month prior. But the trend is not bad. It's coming down a lot slower than it probably needs to, but it is still coming down.
Yeah.
Right?
Inflation tends to be sticky.
Yeah, it does. And but it's, again, you look at all of the things that are happening right here with wage growth, with inflation overall, with the price of oil, with the bonds coming back to normal, the trend on the stock market. Again, I'm doing this because there's a lot of fear right now. Because, oh boy, we're coming back down again, what have you. And here's the fear gauge. This is kind of my last point. So this is from Bank of America. It's a bull and bear indicator. It's a gauge of, essentially professional money managers.
Yep.
And when fear is very high, that has shown to be a time to buy.
Yeah.
Right? So when this gets below 2, it just hit 1.9, it's a time to buy on a contrarian fear gauge like this.
Yeah, it's happened 20 times since 2002, and the median return for the U.S. stock market is 5.4, and global equities is 7.6. So
that's like over the next quarter.
Yeah, over the next 3 months.
Over the next 3 months, so 5.4 and 7.6.
Yeah.
On global. Okay, so again, we're reaching a sort of an extreme in terms of the fear. Obviously, there's things that we're worried about. We're worried about what's going to happen in the House, and can they get a speaker in place so that they can start to function. We're worried about the potential contagion in Israel, legitimate concerns. But when you look at the stock market, those types of worries tend to bring the market down too fast, essentially is what happened. The stretch, it comes down so fast, and you pull and pull and pull, and eventually it snaps back up. One of my favorite indicators for looking at stretch is the Wilder's Relative Strength Index, RSI, on a 14-day basis. When that gets below 30, we've seen the market jump quite often. It's at 36 now. It's not quite there, but we're kind of lining up, in my opinion, over the next week or two here to kind of maybe stretch down to that level, get to that base of support at 4,200 to 4,100, and then have some type of a snap-off return. And that's been my premise really since July, that we could get to that level, get that snap return upward, and then maybe get some short covering to come in and get a little rally going, and then people start to jump in on that rally. We'll see how this plays out. Obviously, it does depend on these other things and how they're going to play out. But don't discount, and that's been the emphasis behind this show and my daily videos since I started this. This video series started on the 23rd of March 2020, right? Sorry, the 22nd, it was a Sunday. The 23rd was the low for the pandemic. And I didn't predict a low or anything, but I started it because the panic was so high. I just wanted to point out some of the things that were good. The money that was coming from the government, the Federal Reserve lowering rates down to 0, the bond market was skyrocketing, pointing out so that people could have some kind of balance amongst their, thought process. Because we do get so much news that is negative, because that's what people click on, and it's what people like. And if you're trying to drive a business and a marketing aspect, we probably get a lot more views if I talked about all the dire things that could happen, right? It doesn't really fit my personality, so it doesn't work for me. But I also feel like it's the wrong way to look at things if you want to be a good investor. It's about finding a balance between that bad news and sort of the good news. And we want to provide, not Pollyanna thing. We're going to point out some of the things. Last year when the markets come down, we were talking about why and how that works and whatnot. But right now, when you look at, there's an awful lot that I can point to that isn't bad at this point in time. There just is. That's a fact. And so, and not many people are really pointing those out. So hopefully that helps you with this too. So appreciate everybody joining, us for the summary of the market. I really think this is an important thing. Oh, let's cover one more thing, the signals. So Unfortunately, right now we do have double red for the stock market and double red for the bond market. However, and so there's a time to be cautious, no doubt, and just hunker down, wait a little while. It's not a time to panic because there's too many other pieces that are really positive as far as that goes. But we do pay attention to these also. So anyway, thank you very much for joining us this week. Look forward to being able to talk to you again. However, we will not be here next week. We'll be here in 2 weeks.
No,
We'll be here next week, but not the week after. Okay,
Yep.
sorry. Good. Got it.